All right, today we are diving deep into the latest earnings report from Compass Minerals. That's ticker CMP. Let's break it down.
So here's a classic Wall Street puzzle for you. On the surface, the headlines looked pretty decent. The company actually beat its revenue numbers. But then you look at the stock chart for that day, and the stock got absolutely hammered. So what on earth did the market see that the headlines missed? That's what we're here to figure out.
To really get what's going on, we have to start by digging into the numbers for the quarter. And let me tell you, it was, well, a mixed bag is putting it nicely.
Okay, so first things first, let's talk about the good stuff. Revenue for Q4 came in at $227.5 million. Now that's not just up, it's up a really solid 9% from last year. And you know what? It blew past what the analysts were predicting. So on that front, things were looking pretty rosy.
But, and there's always a but, right? This is where things start to get a little fuzzy. You look at the earnings per share, the EPS, which is, a super important profitability metric, and it's like, which report are you reading? Refinitiv says, hey, great job, you beat by 6 cents. But then Zacks comes in and says, nope, you actually missed by 2 cents. When you see that kind of confusion, you can bet investors are getting nervous.
And that confusion really points to the bigger problem here. Because, you can slice and dice the quarterly numbers all you want, but when you zoom out and look at the whole year, they still lost almost $80 million. A big, fat $80 million loss. That tells you everything you need to know. This company is very much in the middle of a turnaround.
Okay, so that's the raw data. Now let's switch gears and talk about the story that management is telling. On the earnings call, they basically came out and said, look, 2025 was the year we got our house in order. It was absolutely pivotal.
And they're calling it their back-to-basics plan. And honestly, when you look at what they did, it's pretty impressive. They had this massive pileup of salt from a couple of weak winters, so they worked that down. They dumped that fortress fire-retardant business that was just bleeding cash. They slashed their overhead costs by a huge 18%. And maybe most important of all, they kicked the can down the road on their debt, refinancing it to buy themselves some time. These are all smart defensive plays.
So what's the big headline from all this hard work? Well, it's this number right here, a $125 million drop in net debt. I mean, that's a 14% reduction. For a company where the balance sheet has been a major red flag for investors, that is a huge, huge deal. And yeah, the CEO, Ed Dowling, he's feeling pretty good about it. He's on the record saying he thinks 2025 will be remembered as a pivotal year. So management is painting this picture of a successful turnaround. But the market saw something completely different.
And that brings us right back to our original question. Why the disconnect? Well, you know how it is in investing. It's a what have you done for me lately kind of game. Past performance is great, but it's the future that really counts. And when Compass Minerals talked about the future, that's when investors hit the panic button. I mean, look at this. The reaction was just brutal and swift. The CEO is out there talking about a pivotal year, and the stock just gets hammered, down 12% on the day, on heavy volume too. That tells you the big players were heading for the exits. The market heard the story and said, no thank you.
So why? What did they say that was so bad? It all comes down to their guidance for the next year, for fiscal 26. First, they said core profits, what they call adjusted EBITDA, are going to be pretty much flat. Okay, not great, but maybe not a disaster. But then they said that volumes in their main business, salt, are actually expected to decline by around 8%. And to top it all off, they're going to have to spend more money on capital projects. So let's get this straight. You're selling less stuff, but you're spending more money? That is a recipe for a sell-off.
And this right here, this is the number that really keeps investors up at night. Their leverage ratio is still sitting at almost 4 times their earnings. Now, what does that mean in plain English? It means they are carrying a ton of debt. And when you have that much debt, you have zero room for error. Absolutely none. If things go south, they go south fast.
Okay, so where does that leave us? On one hand, you've got management saying, hey, we're fixing the company, and they have some real progress to show for it. On the other hand, you've got the market screaming, the future looks rough. Let's put it all together and figure out our call on the stock.
This really lays out the two sides of the coin. The bulls, the optimists, are looking at this and saying the turnaround is happening. They're cutting debt, they're getting lean, they've bought themselves time. But the bears, the skeptics, are pointing to all the red flags. The debt is still way too high. The guidance for next year is weak. And let's be honest, their main product is salt for icy roads. Their whole business model is basically a bet on bad weather. That's a tough bet to make when you're drowning in debt.
So when you weigh all that, we land on a market perform rating.
And what that means is pretty simple. We think the stock is probably going to do fine. Not great, not terrible, just sort of meh, in line with its peers. The good and the bad are pretty much canceling each other out right now.
So here's the final call. We're rating Compass Minerals a market perform, and we're slapping a $20 price target on it. Bottom line, yeah, management's doing a lot of the right things, and that's great. But with that mountain of debt and a pretty gloomy forecast, you just can't get too excited. It's a wait-and-see situation.
All right, let's wrap this up with the key takeaways. What are the 4 things you absolutely need to remember from all this?
1. The quarter was super confusing. Good news on revenue, but a lot of weakness hiding underneath. 2. Management's back-to-basics plan is legit. They are making real headway, especially on paying down that debt. 3. The market doesn't care about the past. It cares about the future, and the future guidance was just bad. It totally wiped out all the goodwill from their recent wins. And 4, our verdict. The turnaround story is real, but so is the risk. That's why we're sitting on the fence with a market perform.
And of course, just a reminder, none of this is financial advice. We're just breaking down the numbers. Always, always do your own homework before you make any investment moves.